but rather this is their rainy day fund, and specifically in case they get sick. So the specific language of this question or the response was, I'm going to use my annuity in case I have a catastrophic illness or I need nursing home care. So that's what they're using these for. And if there's anything left over, then it's going to pass to the kids. So that is what we're talking about here, about these dormant assets and changing priorities, kind of honing in on the trillions of dollars of annuities that are out there kind of hanging out for this exact purpose.
Okay, so priorities have changed. They have a new concern that is on their mind, and that begs the question, well, is that kind of shift in their thought process warranted? Do you think it's an appropriate response?
Oh, absolutely. I mean, you've all seen the stats for the need for care. Okay, the need for care isn't going anywhere. Probably the most common stat that you see is that 68%, and a lot of people will round it up to 70, but the actual statistic is that 68% of people over the age of 65 are going to need some sort of care in their lifetime. And the reason why everyone kind of almost glosses over this is because you've seen it year after year after year after year. I mean, I can think of at least 8-10 years that I have seen this stat in any sort of carrier marketing piece that's trying to pitch any sort of chronic illness or long-term care writer. So it's not changing. This is not a need that's going away. But a stat that you haven't probably seen very often is this 90% number. So let's say you're working with a married couple. If you use that same math, right, that's 68% over 65 will need care, but now you've got two people, you're narrowing that pool to two people, there's a 90% chance that one of that couple, either husband or wife, is going to need some long-term care in their lifetime. Now things just got a little more real, right, when you're working with these couples. But there's a almost 50% chance, it's actually right at 49%, that both of them, both husband and wife, are going to need some sort of care in their lifetime. So I mean, it's a coin toss, right? You sit down with Mr. and Mrs. client and you're flipping a coin. There's a 50-50 shot that both of them will need care or that both of them won't. Again, there's a 90% chance that one of them will. It's just really a phenomenal way to kind of look at the need that just kind of like blew up light bulbs, kind of all over my brain. And so, we need to do something about this. So yes, they are concerned about the need, as they should be. But all those stats, right, stats are just stats. They don't mean anything to a lot of people until you start talking about money, right? Their hard-earned money. So 2017, the most recent Genworth Cost of Care study that they published, which is a phenomenal study. If no one on the phone has checked it out, extremely thorough. So the national average for private room nursing home care in the United States last year was $97,450 a year. Now that's national average. So for those of you on the phone that are right there in California, your state average is over $116,000 a year. And even that can be really low depending on what part of California that you're in. Okay, so those are real numbers. Okay, those are numbers that are going to get people's attention. So if we take those figures, so that let's just use that 97,450 number, and now we start talking about that average length of stay. So if you're kind of on the lower end of the average with a 4-year length of stay, these are your typically, and that's using my air quotes that you can't see, typically non-cognitive related situations. Okay, you're maybe an average of 4 years of needing long-term care. If you are unfortunate enough to go through severe dementia or Alzheimer's, now you're talking approximately 10 years of a length of care. So now, again, if we're looking at this married couple, there's a 90% chance that this couple is going to have to come up with, anywhere from $390,000 to almost $1 million to cover anywhere from a 4 to 10 year length of stay. Okay, but now let's go again with that 50% chance that they both need care. I mean, there is the possibility that this couple is now going to have to come up with anywhere from $780,000 almost $2 million. So the question has to be asked to these people, where is that money going to come from, right? There's an old adage that I love, and it's if mom and dad need care, mom and dad get care. The money will come from somewhere. So where are you going to start pillaging from if you don't have a plan, right? Is it going to be from their income that they set up to live on? Are they going to have to, pillage their legacy that they hope to leave behind? But it's got to come from somewhere. But the most, kind of shocking stat that I still can't believe hasn't really changed much is that knowing all of this and knowing that people are actually concerned, right? Because the Gallup poll showed it, still only 11% of people over 65 have any sort of a formal plan in place to tackle this potential, massive price tag coming down the pipeline.
Okay, so that's a sobering set of statistics, Jamie. But and look, for the advisors who are on the phone, that probably makes a bunch of sense, and they may have even heard some of these stats previously. To your point, but it's not personal, and that's what really that emotion is. What is going to make that client really take this to heart and be willing to take action on it? So let's just talk about their strategy of using these rainy day annuity assets that are dormant, to your comment from earlier, to address their need for care. What is going to happen if they execute on that strategy?
Quite frankly, it's just kind of they're setting themselves up for fail. I mean, if they do in fact need care and they want to use that annuity, they've got two options. Okay, they can either trigger any sort of an income rider that they have on this annuity. Some of them do have a doubler provision for nursing home. That's great. Lots of different ways that the different products work. Sometimes it'll double, but only until your actual principal runs out. Then you're back to your normal distribution. So maybe they want to do that, or maybe they just take some distributions as needed, help cover those costs, and just hope that there's something left. But either one of those options, they're running the risk of, completely using it all up. Okay, they're just not going to have enough to cover everything. So now it's all gone. There's nothing left, for the kid regarding that asset. So, disinheriting the kids from that annuity. But I think more importantly, what it's doing is, unless that's a multi-million-dollar annuity, they are exposing the rest of their assets to be tapped into, because there will be an endpoint to that annuity. Okay, it's probably not going to cover the entire price tag. So where are we going to go next to keep grabbing those funds?
All right, and to your point from earlier, there's a 50% chance that couple is going to have that big kind of double claim that's going to have a nearly $2 million price tag potentially if there's an extended need for care. So there's the pretty blunt response to this question of what does this mean to their strategy, and frankly, being blunt may be what's required to get some clients' attention. They would just rather not deal with this. And look, I understand that thought process. Thinking about this kind of stuff is not fun. The good news, though, and really the reason that we want to get on the phone and talk about this today is not to make everybody depressed about this unfunded need, but that there is actually good news. There are strategies out there that will help this client use that asset in a more efficient way to get after this need for care that the numbers say they're likely to face during their lifetime. So let's start talking about solutions.
Yeah. Well, the solution that I'm talking about today was really just kind of born out of your annuity max strategy. Okay, everybody, I just about bet my dollar that everybody on this call knows what annuity max is or has implemented successfully for their clients. So, but for those of you that don't, super high level, what you're doing here, the benefit of doing an annuity max strategy is you're taking that annuity that they don't want for income anymore. They're just going to either use it if they get sick, or more than likely they're just going to pass it to their kids. Okay, so we're going to leverage that annuity, help the client spread their taxes over time, and we're going to leverage those distributions into life insurance premiums. Okay, so more often than not, we're in a kind of a large no lapse guarantee second to die contract. So we're taking a taxable asset, leveraging it up to the kids, let's say, into a larger tax-free death benefit. Okay, the downside to that strategy, even though that is absolutely excellent for legacy planning, is there's little to no cash value in those policies, so they're kind of losing some liquidity there. And there's little to no benefits at all for them for long-term care. So we're taking care of legacy planning, but we're still leaving this gaping hole in the long-term care planning. So there is a product, though, available through Nationwide. So this is kind of maybe your more modern twist on Annuity Max. This situation runs across my desk at least a couple times a week, if not more, asking me to take a look at this. So Nationwide has a no-lapse SUL product that has a long-term care rider that allows both insured to access half the death benefit for long-term care while they're both still living. Okay, so that is very different than the usual approach. If you can add one to an SUL, it's generally only available to a surviving spouse. So first spouse that needs care, sorry, no benefits for you. Okay, so not a bad plan, but let me kind of show you a little case study of what this particular product with Nationwide would look like. Okay, so let's say we have a couple, husband 70, wife is 68. Let's say 10 years ago, he purchased a qualified annuity. Okay, he doesn't have to be qualified for any of this to work. Just quite often, that's what I'm working with in my day-to-day. So now 10 years later, it's worth $300,000. Okay, he's got a guaranteed income rider on here. So we're going to just net him out after taxes to a $26,000 annual lifetime income from that annuity. Okay, so if we were to do an Annuity Max strategy on this, we're going to take that $26,000 and use it for a premium on the Nationwide no lapse guarantee SUL. So what that gets for them is an $820,000 death benefit. So we turned $300,000 into $820,000. And I'm sure everyone already, you're probably running some math in your head and like, that seems a little low. We could generally do better. And yes, you could, but there's this long-term care rider on here for both insureds, and there's a cost to that. So in this case, you got your $820,000, but each insured, both husband and wife, can access $8,200 a month for long-term care for 50 months. So they're each getting half of that death benefit, and it's accelerated at 2% per month. So this would be kind of a little bit more of a modern twist on an Annuity Max strategy. Fantastic, for right situations. I still think we can do a little bit better.
Yeah, you're stealing your own thunder with that comment, Jamie. I got to be honest. But to your point, on the surface, this sounds great. $300,000 leverage to $820,000 in long-term care coverage, and if the client doesn't need the coverage during their lifetime, that $820,000 passes on to their kids, grandkids, whatever beneficiary they have that they have gone ahead and designated. That would seem to be mission accomplished, but there are some challenges here to this strategy.
Yeah, possibly, right? So if these clients completely defy all the odds, right, and none of them need care, then I would say yes, mission accomplished. But there are some challenges here that I don't think are being thought all the way through. So first of all, it might not be enough, okay? So that half of the death benefit over 50 months just may not be enough, okay? Then these are those extended care events. I haven't really talked about any sort of Alzheimer's stats, but guys, they're kind of terrifying. The amount of people that have Alzheimer's today, the amount of they're projected over the next 10, 15, 20 years, and those average lengths of stays are tremendous. So, there is a risk here that if this is their only strategy, is half that death benefit, 50 months, they're going to run out, right? And then we're going to have to start going after some other assets. But I think that the more important thing to talk about here is, you're purchasing this death benefit for a reason. Okay, so if you start coming in here and you start using up that death benefit for your care, now the death benefit's gone. Or in this case, if one person's on it, it's half gone. So there's a risk there, again, of this whole disinheriting the beneficiary. So, I have some concerns. with that. So let me just show you some visuals of what I'm talking about here and the effect that these claims have. So this first chart is showing a single claim. Okay, so this is just one of them going on claim for their $8,200 a month, which is $98,400 a year for 50 months. Now let's look at the impact that that claim has on the death benefit. Okay, so that orange line here, that's our death benefit. So you can see as the claim's coming out, we're depleting half of that death benefit. Okay, so claims done, half the death benefit is still there. Okay, so this next chart though, this is going to show the impact of a double claim. Now, this one can get a little bit crazy looking, so let me kind of walk you through what we're looking at here. So this first mark here, okay, this is husband going on claim first, let's say for 2 years. Okay, then you're going to see a spike up here in year 3. What I'm showing you here is now let's say wife goes on claim. So we're double claiming. So, you've got your $8,200 a month now for 2 people. We're pulling out, just under $197,000 a year out of this policy. Okay, then you're going to see a little dip here. This is the husband finishing up his last 2 months, right? Because it's a 50 months, so it's a little over 4 years. And then this next little dip here, this is our wife, okay, finishing up her last 2 months. Okay, so now we're at 0. There's just nothing left. We've used up all of the long-term care for this couple. But now when we look at the impact of a double claim, I know there's a 50% chance of this happening. There's no death benefit left. So now we checked the box that we covered some claim for them. Hopefully this is all that they needed, but we did not check the box of leveraging any sort of legacy to the beneficiaries or the kids more than often than not. So that's a risk. Okay, is it the end of the world? Hopefully not if there's other life insurance in place. But if this was the strategy to take care of both, how well did we do?
Yeah, I think the question, Jamie, is did everybody understand, clients, their beneficiaries, kids, et cetera, understand that this is how the product actually worked when they bought it? And if they did, and there are other assets, and it was a partial, let's insure a portion of the risk type of strategy, I think this is fantastic, right? It's discovering this by a surprise because perhaps the advisor didn't understand exactly how it worked, or the client forgot, or didn't share with the beneficiaries, or whatever the case may be, that all of a sudden, year 8 of this claim, when everything has been depleted, becomes a really uncomfortable conversation for everybody. The good news, though, is that this is not the only solution that we want to unpack today, this nationwide. We think it's step one. It's part of the possible range of solutions, but there's the next level, so to speak, that Jamie likes to take things to, and that's what we're going to talk about next. The good, better, best. This would be the best that we can come up with from a risk management standpoint.
Yep, so I like that, good, better, best. So I'm still using this annuity match strategy, okay? But I'm gonna add in an additional layer of protection. So in essence, what I'm doing is I'm separating church and state, okay? I am separating out our legacy planning from our long-term care planning, still using that same asset. So what I'm going to do here is I'm going to take, that income stream from that annuity in our previous example, okay, but I'm going to purchase 2 policies. I'm going to do an asset-based long-term care policy, and I'm going to do another second to die. I'm actually going to use a guaranteed death benefit indexed survivorship product, so I can still guarantee some death benefit here. Okay, so for that same couple that we were just working with, let's say that $8,200 a month LTC amount from that Nationwide, they really like that. They think that's great. Let's roll with that. So I kind of backtracked for my example here, and I looked at, okay, what is that going to cost to get them $8,200 a month each, but for 2 lifetimes? And I'm able to do that with the One America Asset Care 4 policy. Okay. That actually gives them a $205,000 second to die death benefit. And the balance of the premium, I'm now purchasing that guaranteed death benefit index survivorship product. Okay, so that death benefit is just over $402,000. So combined, using that same $300,000 annuity, I'm getting them a combined death benefit of $652,000. So should, again, they defy the odds, nobody needs care, we've leveraged that up to a tax-free death benefit to the bennies. But if they do need care, I now have $8,200 a month for each of them for both of their lifetimes. So now let me show you the impact of a claim on death benefit. Maybe hopefully those will kind of all drive it home here. So this first chart here, this is showing, again, one of our insureds, again, let's say it's husband, going on claim. So he's taking his $8,200 a month, but it lasts as long as he needs it. So we're not seeing any dips, we're not seeing anything drop off to that zero amount. Now let's look at the impact on the total death benefit for his claim. So you're going to see a dip there in that death benefit. That's the loss of our One America death benefit. So we, kind of use that up first, but then we're leveling off because that is our survivorship death benefit from our other policy that we're not having to touch. And now let's look at a double claim scenario again. Same exact scenario that we used last time. So husband's going on first, then wife's coming on. This is why you're seeing your spike. Okay, so now we're actually taking almost $200,000 of claim every year for their long-term care out of the One America policy indefinitely with no endpoint. They will never hit a zero. But again, look at our death benefit. Stays level. Okay, we're never going to have to tap into that $402,000 survivorship policy with our index product. So I'm insulating all parts of the planning here. It's a very holistic planning. Taking a dormant annuity and we're checking all the boxes, okay? You don't want this for income anymore. How can we leverage this for you for something that actually makes sense and meets your needs? So we've checked the box for, we're taking care of even an extended care event should that happen. If it doesn't happen, we've got death benefit. We've checked the box on locking in some death benefit for the beneficiaries. We're not going to have to deplete that. So, it just, in my opinion, even with a little bit more of a drop in the overall death benefit, just knowing that we've insulated, their LTC, their legacy, as well as all of their other assets, right, that we're not going to have to tap into now, to me, it's just a win-win-win all the way around.
Well, and I'll be honest, I think intuitively, Jamie, there's a bunch of us, myself included, that gravitate towards a simpler solution with a single policy, particularly when dealing with clients who are perhaps a little longer in the tooth. But when you lay out the economics of an actual claim scenario like you have here, the two-tiered strategy, it's actually far simpler when you really need it most. So I'll trade the complexity of managing two policies, if that really is altogether that complex, perhaps not, for far greater clarity and really superior benefits, all day long. I'll make that trade all day long. Of course, there's one other topic, issue, whatever you want to call it, relative to today's title that we have not touched on. We've talked about dormant assets. We've talked about changing priorities. We haven't touched on this idea of 2024 sight. So what do we mean by 2024 sight?
So 2024 sight, obviously, is just the opposite of, 2020 rear view vision, right? Woulda, coulda, shoulda. So this is your opportunity to work with your early planners. And they're out there. These run across my desk all the time as well. So these are your people in their 40s and their young 50s. They still got kids either at home or, putting them through college. They still got life insurance needs to plan for. But they're also cognizant of long-term care. Okay, they want to make sure that box is checked too. So these are those clients that will absolutely engage with you in this conversation because they see the vision. They want to work with you, and that they want to make sure that everything is put in place. So we can still use this whole idea of, layering or stacking two policies together, even though these aren't your clients that have a dormant asset to pull from, right? So we're just pulling from, the same assets that we would, for any other sort of life insurance planning. So let's run through a little case study on this one. So let's say in this situation, husband's 50, wife is 48. Okay, and they've got $15,000 available a year for some life insurance planning. So they want to make sure, though, that death benefit is going to each other, right? For all the reasons why you purchase life insurance. So we're going to switch it up here just a little bit out of SUL into individual policy. So for that $15,000 a year, what you would typically maybe gravitate to is 2 individual life insurance policies with a long-term care rider. Okay, so if we were to put them into IULs with a long-term care rider, you'd be looking at a combined death benefit between the two of right around $1.3 million. Okay, so but from a long-term care perspective, husband's able to get $11,500 a month. Wife is getting $14,800. Those are with a 2% acceleration of death benefit, so for a total of 50 months. Now, again, is this an awful strategy? No, it's not. If there's a short claim event, it can very well work, but I don't think we need to beat the statistics into everybody's head anymore. So there's still the same challenges here. There's still the same potential risks. Okay, so there's still the risk that they're going to run out of the acceleration available to help pay their total cost of care. And there's still a very, very real chance that the husband's going to disinherit the wife's going to disinherit the husband, or the kids, or however they have their beneficiary structure set up. If, again, this is your tool, to pass on a death benefit, right? How is the mortgage going to get paid for? How are the colleges going to get paid for? All those reasons why they purchased life insurance to begin with, just putting all of that at risk. Okay, so let me show you those same kind of charts here about an impact of claim on these policies. So we're going to just say this is the husband. Okay, so husband goes on claim. So he's getting his $11,500 a month for 50 months. Okay, now let's look at the impact on the death benefit, and it's gone. There's nothing left. So yes, we helped, probably insulate some assets to pay for his care, but when he passes away, wife and kids left behind get no death benefit. Okay, and the same exact story is going to go for the wife, so we don't need to show you those as well. So here's my strategy. Here's what I would position for them for that same $15,000 available premium. I just, went for a target of right around $10,000 a month for long-term care. It actually ended up equaling $10,100 a month. That is for joint lifetime benefits, again, using One America's Asset Care 4 with a survivorship structure. Okay, so we've got that going, and that actually comes with a death benefit of $253,000 should, again, they never need the care. And now I took the balance of that premium, and I've got 2 IULs for the husband and the wife, but without the expensive long-term care riders attached to it. So husband's IUL, just so you know, came up to like $345,000, and wife's was $453,000. So total combined death benefit just over $1 million. Okay, so now let's look and see what happens if the husband goes on claim. So now he's getting his, $10,100 a month. But again, level, no endpoint, as long as he should ever need it. And now let's look at the impact on the death benefit. Okay, again, you're going to see a little bit of a dip here. That's because we lost our One America death benefit, but his death benefit to his family from his IUL remained untouched. So again, we've covered all parts of the planning spectrum here, leveraging their premium to cover both the long-term care built on an asset, right, of that life insurance, and still left legacy in place as well. And again, we don't need to show you the wife would be the same exact scenario, except her death benefit would be a little bit higher at $450,000.
Okay, so there is the story for these clients with 2020 foresight. Similar challenges, similar solution in terms of the strategy, but again, focused on a client that has not reached the point of having a dormant asset to fund their strategy. There's a whole other layer to this. in my other job, so to speak, I spend an awful lot of time looking at planning strategies on the more traditional life insurance side of our business, kind of as a companion to Jamie's work here on the asset-based long-term care segment. And if we're looking at IULs here in this single life example, and that client made it to retirement and decided to turn on an income stream out of their IUL contract, and it had one of these chronic illness or long-term care riders built into it that they intended to use for care. It's a longer discussion that we're not going to get into really deeply today, but most clients view that as an and, meaning I have the ability to take income and I have chronic illness or long-term care benefits, when the reality is that it's an or. I can take income out of my IUL contract, or I can preserve some chronic illness or long-term care benefits. So there's a whole secondary reason beyond what Jamie just unpacked, if we're looking at this type of client that's looking at an IUL contract for income, that any of the folks at Cavalier Associates can go deeper on with you if you want to investigate it a little bit further. For now, though, I do want to remind you that we have a Q&A session rapidly approaching. And if there are any outstanding questions rattling around in your gray matter, please go ahead and type them in via that dashboard. We've got a couple of them queued up already, and we will get to them in just a moment. For now, though, while those come in, Jamie, let's bottom line it. If we take both of these fact patterns, the older client with the dormant asset and the changing priorities, as well as these clients with the 2020 foresight, and we think back about what we've actually accomplished by executing on your layered or stacked policy strategy, what did we accomplish?
We just accomplished some very holistic planning for these couples. Checked a lot of boxes. So, first we just gave them a very substantial, far greater pool for long-term care than we could ever accomplish with those riders attached to their, death benefit focused policy. Okay, so they're completely insulated from the risk of an extended care event. We've got that covered. We've also guaranteed their long-term care premium. So kind of took a big old leap of faith here coming into this call that everyone on here kind of understands asset-based long-term care, how that differentiates from your traditional. But one of the big keys here is not only are we built on a life insurance policy that, in case they don't get sick, we actually still have some leverage for them, further beneficiaries, but everything in these contracts is 100% guaranteed. Okay, their death benefit, their long-term care benefits, as well as their premiums can never change. So especially for a younger couple, right, who could be paying these premiums for long-term care insurance for a very long time, knowing that they're locked in at those great pricing at those younger ages is a huge, huge benefit. So we've been able to do that for them as well. The liquidity, we didn't even touch on this besides just mentioning the word indexed a few times. I did that by design on my choice of products. Okay, because remember, your typical annuity max strategy, you're just trying to get the most death benefit you can, which is fantastic, but there's no escape hatch, right? Should needs change, and needs always change. So we've built everything with, products that have liquidity. So the One America product itself has a guaranteed minimum 4% interest rate on the cash value. So constantly going to have some growing cash value there for them. And then with these, guaranteed death benefit, that's a big, want to make sure that box is checked. We've got the potential there, obviously, with the indexing to, get between the two policies some fantastic liquidity for emergencies. And again, if needs change down the line. And then obviously we've locked in some legacy. Okay, that was important for me to cover as well. So yes, we have our One America death benefit, but should we use that for care? I've still got my secondary life insurance policy to pass on as a legacy for whatever reason they need to do so. You run through the list of all the reasons you buy life insurance. We haven't had to touch that. So agent doesn't have to have that horrible conversation with the client's children. Where's mom and dad's death benefit? Well, sorry, it's gone because we used it for care, right? Well, why didn't they have long-term? You see the picture. So we've eliminated the risk of that conversation ever having to happen. And then finally, we insulated the rest of their assets. Okay, so we preserve those by having that joint lifetime long-term care benefit with the One America policy. We've protected the whole entire rest of the portfolio from needing to be depleted for those extended care events. So they can be used for the income. They can be used for other parts of their legacy. Whatever they wanted to use them for, they still can. Okay, we're not going to have to deplete those. And again, having some really uncomfortable situations if an extended care event were to happen. So holistic, all using the same asset, getting a little creative, thinking outside the box, as you would say, Jeff. And
I never say that. What are you talking about?
Covering yeah, you never say that. Yeah, so 2 policies as opposed to 1. That's what we did.
Yeah, and that's a theme actually with a lot of our work here recently when we've started to look at this idea of combining multiple kind of planning objectives into a single policy solution. It's almost the Swiss Army knife story, or the jack of all trades, master of none story, where yeah, it's good, but maybe it's not the best. For now, let's jump into some Q&A. There are a handful of them that have come in here. And before we jump into those, there's one comment that you made that I want to make sure everybody heard, because it can be perhaps a distraction. We've used in the dormant asset portion of today's conversation a qualified annuity, but that's not the only asset that would actually, or even type of annuity for that matter, that would work for this kind of strategy. True?
Oh, absolutely. Yeah, so, dormant assets, like I said, could be anything. Cash, annuities, mutual funds, just any sort of asset that's just hanging out, so long as they don't need it for the original purpose that they purchased it for, it's kind of up for grabs. You'll actually, if you ask some pointed questions to clients, they will always have an answer. Just ask them, like, of all of these assets, which one is on your short list if you were to get sick? They'll point to something, right? It's